Hi everyone, I'm George.
And I'm Selina. Today we're going to talk about the different types of stock orders you can use when investing on your own.
As discussed in a previous Money Gains video, you can choose to invest either through a financial advisor or on your own, known as do-it-yourself investing. For those who choose DIY, there are several types of stock orders that are important to understand before logging into your trading app and entering your stock orders. The two most common types of stock orders are market orders and limit orders. But there are other important ones to consider, like stop orders, stop limit orders, and trailing stop orders.
That's right, George. To help you understand, we'll use a real-life example that you can relate to. Imagine you're in high school and have saved up some money from your part-time job. You've decided to invest in a popular sneaker company called Kicks Unlimited, which everyone at school is talking about.
Let's start with market orders. A market order is the simplest type of order. It means you want to buy or sell a stock immediately at the next available price.
For example, if you want to buy shares of Kicks Unlimited and the current market price is $50 per share, placing a market order will buy the shares at around $50. This way, you get the shares right away. Market orders are most popular among those who want to buy or sell a stock without delay.
Exactly. In fact, the advantage of a market order is that it's executed as soon as possible, which means that you're guaranteed to get the trade filled. The downside is you don't know the price that the stock will be bought and sold at. The price depends on what we call bid and ask prices, where the bid price is the price buyers are currently willing to pay for the stock, and the ask is the price sellers are willing to sell at.
Next up, we have limit orders. A limit order lets you set the maximum price you're willing to pay when buying, or the minimum price you're willing to accept when selling.
So if you want to buy more shares of Kicks Unlimited, but you're only willing to pay $45 per share, you can set a limit order at $45. If the stock price drops to $45 or below, your order will be executed. Otherwise, it won't be.
For both market and limit orders, there are three things to consider. 1. Brokerage fees, because brokerage platforms charge a price to place both types of orders. 2. Bid-ask spreads, because the final cost is usually affected by the difference between the bid, which is the buy, and ask, which is the sell prices, particularly for market orders. And 3. Order duration, because the fees and execution probability are likely influenced by the different durations that limit orders set.
Now, let's move on to stop orders, often called stop-loss orders. With a stop order, you buy or sell a stock once the price reaches a specified price, known as the stop price. When the specified price is reached, your stop order becomes a market order. Think of these orders as a shield. They're typically used to limit a loss or protect a profit on a stock that you own.
For example, you bought Kicks Unlimited at $50 per share and want to limit potential losses. You might set a stop order at $45. If the stock price falls to $45, the stop order becomes a market order, and the stock is sold at the next available price, helping you avoid any further losses. This strategy can help provide you with peace of mind, even in volatile markets, knowing that your position will automatically be sold if it reaches the price you selected.
The next type of order combines the features of a stop order and a limit order, a stop limit order. As the name suggests, there's a limit on the price that will be executed. There are two prices specified in a stop limit order. The stop price, which will convert the order to a sell order, and number 2, the limit price. The sell order becomes a limit order that will only execute at the limit price or better.
So you could set a stop limit order to sell your Kicks Unlimited shares if they hit a stop price of $45 and a limit price of $44. Once the stock hits $45, it will trigger a limit order to sell at $44 or better. If it can't sell at $44, the order won't be executed.
Finally, let's talk about trailing stop orders. These are a bit more advanced. A trailing stop order sets the stop price at a fixed percentage or dollar amount below the market price for a sell order, or above the market price for a buy order. The stop price adjusts as the market price fluctuates.
For instance, you set a trailing stop order to sell your Kicks Unlimited shares with a trail of $2. If the stock price rises from $50 to $55, your stop price will move from $48 to $53. If the stock price then falls to $53, your order is executed, locking in your profit.
Now, I understand that was a lot of orders to process, so let's summarize with a quick recap using our example of Kicks Unlimited.
With a market order, you can buy or sell immediately at the next available price. For example, buying Kicks Unlimited at the next market price of $50.
A limit order lets you set a maximum purchase price or minimum sale price. For example, buying Kicks Unlimited only if it drops to $45.
You make a stop order, also known as a stop loss order, to sell stocks to prevent further losses. For example, selling Kicks Unlimited if it drops to $45.
A stop limit order combines stop and limit orders. For example, selling Kicks Unlimited if it drops to $45, but only if it can be sold for $44 or better.
And trailing stop orders set a stop price based on market price movements. For example, selling Kicks Unlimited if the stock drops $2 from its highest price after purchase.
And that's it. We hope that understanding the different types of orders will provide you with more confidence when placing your own trades if you choose to be a DIY investor.
Be sure to continue watching more Money Gains videos. Have a great day.